I was throwing away 180 bucks every single month on my mortgage and I didn't even know it. But here's the crazy part. My lender told me I'd have to wait 11 years to stop paying it. That's over 23 grand down the drain. But I found a loophole that got me out in just 3 weeks, and I'm about to show you exactly how I did it step by step. Section 1, the PMI trap. Look, if you put down less than 20% when you bought your house, you're probably paying something called PMI right now. And here's what nobody tells you about it. PMI stands for private mortgage insurance, and it's basically the biggest scam in the mortgage industry. You're paying anywhere from 100 to 300 bucks a month for insurance that doesn't even protect you. It protects the bank. Yeah, you heard that right. You're paying to protect your lender in case you default. Let me break down the math real quick. On a 300K house with 5% down, you're borrowing 285 grand. With PMI at 0.75%, that's 178 bucks a month. Over 10 years, that's over $21,000 you're just handing over to your bank for absolutely nothing. And here's what makes it worse. Most people think they're stuck with it until they pay down 20% of their loan. That could take a decade with regular payments. But I'm going to show you how to get rid of it way faster. But first, smash that like button if you're ready to save some serious cash. And make sure you're subscribed because I'm dropping real estate money saving tips like this every single week. Section 2, the myth everyone believes. All right, so here's the myth that keeps people paying PMI for way longer than they have to. Everyone thinks you need 20% equity to get rid of it. And technically, yeah, you need your loan to value ratio, that's your LTV, to hit 80% or below. But here's what most people don't get. There are two completely different ways to hit that 20% equity mark. Way number one is the slow way. You just keep making your regular mortgage payments month after month, year after year. Your principal balance slowly goes down and eventually you hit that magic number. Like I said, this could take 10 to 12 years depending on your loan. But way number two, this is where it gets interesting. Your crib goes up in value. And when that happens, boom, you gain equity without paying down a single extra dollar of your mortgage. Check this out. I bought my place in late 2021 for 300 grand. Fast forward 2 years and homes in my hood are selling for 340 grand. That's $40,000 in appreciation. And here's the kicker. I only put down 15K when I bought the place, but now I've got way more equity just from my house going up in value. And this is happening all over the country right now. The National Association of Realtors says the median home price has jumped over 30% in the last 4 years. That means millions of homeowners are sitting on equity they don't even know about. Section 3, the loopholes nobody talks about. Now here's where most mortgage companies hope you never find out about this stuff. There are actually 4 different ways to ditch PMI without waiting forever, and I'm going to walk you through each one. Method number 1, mortgage recasting. This one's pretty slick. Let's say you get a fat bonus at work, maybe a tax refund or an inheritance. You can take that chunk of change, make a lump sum payment toward your principal, and then ask your lender to recast your mortgage. What this does is it recalculates your monthly payment based on your new lower balance. Most lenders charge you a fee for this, usually around 250 to 500 bucks. But if that lump sum brings your LTV down to 80%, you can request PMI removal at the same time. 2 birds, 1 stone. The catch is, not every lender offers this. You got to call and ask specifically about mortgage recasting. Method number 2, refinancing. Now, if interest rates have dropped since you bought your house, refinancing is a no-brainer anyway. But even if rates haven't moved much, you might still save money. Here's why. When you refi, your lender orders a brand new appraisal at today's value. If your house is appreciated, your new loan amount might be 80% or less of what the house is worth now. Boom, no PMI on the new loan. You do got to watch out for closing costs though. Refinancing typically runs you 2 to 5 grand, so you got to run the numbers and make sure you're actually saving money in the long run. Method number 3, the BPO strategy. This is what I did. All right, this is the method that saved me 180 bucks a month, and honestly, it's the easiest one. Most people don't know this, but almost every mortgage lender will let you request PMI removal if you can prove your home's current value puts you at 80% LTV or below. Here's exactly what I did. First, I called my loan servicer. In my case, it was Rocket Mortgage, but this works with pretty much any lender. I asked them straight up, what's your policy for removing PMI based on home appreciation? They told me I needed to have the loan for at least 2 years. Some lenders only require 1 year, and they need a new property valuation. Now here's the key part. They said they'd accept something called a BPO. That's a broker price opinion. This is way cheaper than a full appraisal. A BPO runs you about $75 to $150. A full appraisal, that's $400 to $600. But they'd only accept the cheaper BPO if my LTV was between 75% and 80%. If I was claiming I had more equity than that, they'd want a full appraisal. So I did my homework first. I went on Zillow and Realtor.com and looked at what homes in my neighborhood were actually selling for. Not listing prices, but actual sold prices from the last 3 to 6 months. I'm talking about houses with the same square footage, same number of bedrooms and bathrooms, same area. I saw that comparable homes were going for around $340K. I originally paid $300,000 and I still owed about $278K on my mortgage. So I did the math. $278,000 divided by $340,000 equals 81.7% LTV. I was close, but not quite at that 80% mark yet. So here's what I did. I took $6,000 from my savings and made one extra principal payment. That brought my balance down to $272K. Now my LTV was exactly 80%. Perfect. I submitted my request in writing to my lender, paid for the BPO, and 3 weeks later, I got the confirmation letter. PMI removed, just like that. That $6,000 payment paid for itself in just over 33 months of PMI savings. After that, it's pure profit. $180 a month back in my pocket every single month. Method number 4, lender-specific programs. Some lenders have special programs that most people never even hear about. For example, certain credit unions offer PMI buyout options where you pay one lump sum up front instead of monthly payments. Others have first-time homebuyer programs with lower PMI thresholds. Some will remove PMI at 75% LTV instead of 80% if you meet certain conditions. The key is to call your lender and specifically ask, what are all my options for ditching PMI? Don't just accept the first answer. Push them to check all their programs. Section 4, your exact step-by-step game plan. All right, let me give you the exact step-by-step process so you can do this yourself. Step 1, call your loan servicer. Don't email, don't use their app. Call them. Ask these specific questions. How long do I need to have the loan before I can request PMI removal? What LTV percentage do you require? Is it 80% or will you accept 75%? Do you accept a BPO or do you require a full appraisal? Are there any fees for the removal process? Do I need to have a perfect payment history? Write down everything they tell you. Get the rep's name too, just in case. Step 2, research your home's current value. Go on Zillow, Realtor.com, and Redfin. Look for homes that sold in the last 3 to 6 months that are actually comparable to yours. Same hood, similar square footage, same bed and bath count. Don't just trust the Zestimate or automated values. Look at what real buyers actually paid for similar homes. Write down at least 5 comparable sales and average them out. Step 3, calculate your current LTV. This is simple math. Take your current mortgage balance and divide it by your estimated home value. You can find your exact loan balance on your most recent mortgage statement or by logging into your lender's website. If you're at 81% or 82%, consider making an extra principal payment to push yourself under 80%. Do the math to see exactly how much you need to pay. Step 4, submit your written request. This is super important. Don't just call and request it verbally. Send an official written request. You can do this through your lender's online portal, email, or certified mail. Include your loan number, your property address, your current loan balance, and state clearly that you're requesting PMI removal based on current home value. Reference the phone call from step 1. Step 5, order and pay for the valuation. Your lender will coordinate this, but you're going to pay for it. If they'll accept a BPO, go with that. It's way cheaper. They'll send someone out to do a quick exterior evaluation and comp analysis. If they require a full appraisal, you're looking at a more detailed inspection. Either way, this usually happens within 1 to 2 weeks of your request. Step 6, wait for approval. This typically takes 2 to 4 weeks total. The lender reviews the valuation, confirms your LTV is at or below 80%, and verifies you have no late payments in the past 12 months. Once approved, they'll send you a confirmation letter or email, and your PMI will be removed starting with your next mortgage statement. Step 7. Verify it's actually gone. When your next mortgage statement comes, check it carefully. Make sure the PMI line item is gone and your new payment amount is correct. If there's any issue, call immediately. Also, check your escrow account. Sometimes when PMI is removed, your total payment drops and you end up with an escrow surplus. You might get a refund check. That happened to me. I got an extra $340 back. All right, important requirements. Now, before you run off and do this, there are a few requirements you need to know about. Number 1, most lenders require you to have had the loan for at least 1 to 2 years. Some will make exceptions, but that's the general rule. Number 2, your payment history needs to be spotless. No late payments in the past 12 months. Some lenders want no late payments ever. Number 3, you can't have any secondary liens on the property. That means no HELOC, no home equity loan, nothing. If you do, you got to pay those off first. Number 4, some lenders won't remove PMI if you've done any major renovations without permits. So if you finished that basement or added a deck without pulling permits, that could be an issue. All right, this was one of the smartest financial moves I've made. $180 a month might not sound like a fortune, but that's over $2,100 a year. Over 10 years, that's over 21 grand back in my pocket instead of going to the bank. And you can use that cash for literally anything. Pay down your mortgage faster, invest it, build up your emergency fund, take your fam on vacation, whatever you want. If this video helped you out, do me a solid and smash that like button right now. It really helps the algorithm push this video to other people who need to see it. Drop a comment below and let me know. Are you paying PMI right now? What's your monthly amount? I read every single comment and I'll try to answer your questions. And if you're serious about saving money on your mortgage and building wealth through real estate, hit that subscribe button and turn on notifications. I drop videos every week with real strategies that actually work. Thanks for watching, and I'll catch you in the next one.